Well, there's been a lot of talk lately about what really happened on the coin show floor when silver went from exciting to downright disorderly. So in this video, we're going to separate the noise from the reality, and you are going to walk away feeling a lot smarter and a lot more confident the next time somebody tells you the physical market is either completely broken or completely fine. And by the way, it is Saturday, April 11th in New York, so go ahead and tell me the day and date you're watching from down in the comments. And real quick, if you value this kind of breakdown, support the channel by subscribing and by commenting John AG Best. That lets me know you want more of this kind of boots-on-the-ground market work. I spent the day walking a major coin show, talking to dealers, wholesalers, table holders, show people, the whole thing. And let me just say this right up front. Some of what I heard was encouraging. Some of what I heard was messy. And some of what I heard should make you think twice before you assume a rising silver price automatically means an easy silver market. A lot of people see a metal go up and they imagine every dealer is happy. Every refiner is taking everything. Every stacker can cash out whenever they want. And every coin show turns into a silver rush. That is not how this works. What I found was a much more human picture. Some dealers were doing business as usual. Some had stepped back from bulk silver. Some were still selling but were far more careful on the buy side. Some would pay up for the right material. Some wanted nothing to do with generic at the wrong moment. And a few looked like they'd spent the last several weeks trying to catch bowling balls with oven mitts. Now the show itself was strong, really strong. People were there. Tables were active. Inventory was moving. Collectors were active. Bullion was too. There was good energy in the room. But underneath it, there was another story, and it had to do with speed, stress, and what happens when too much metal tries to squeeze through too few pipes at once. That's really the heart of this. Speed. Velocity, panic, opportunity colliding with logistics. And if you've ever wondered why one dealer says, "No problem, I'm buying silver," while the next guy says, "No thanks, not touching it," even though they're standing maybe 20 feet apart from each other, this is exactly why. The first thing that jumped out at me was how split the dealer community sounded. There wasn't one clean message. It was more like a room full of people describing the same storm from different windows of the same building. One dealer basically told me demand at the show was solid, buyers were engaged, and his own pricing on rounds was still pretty reasonable in percentage terms, even if the dollar premium looked bigger than people were used to seeing. His point was simple. If the metal itself rises a lot, the premium can look dramatic in raw dollars even when, relative to the underlying price, it hasn't blown out nearly as much as people think. And honestly, there's truth in that. If something used to trade at a much lower base and now trades at a much higher base, a premium that sounds outrageous in dollar terms can still be pretty normal in percentage terms. That doesn't excuse bad pricing, it just means not every sticker shock moment is a scam. But then he pivoted, and this is where it got interesting. He said some dealers had widened things way too far. In other words, it wasn't just a question of what they were charging to sell, it was what they were willing to pay when someone came in to liquidate. And when you put those two sides together, the total gap could get ugly in a hurry, because a lot of stackers focus on the sell ticket when they buy, and forget about the buy ticket they'll face later. On the way in, everybody talks about premiums. On the way out, spreads become very real, and that was one of the big themes of the day. Spreads. The full round trip. What's the gap between the dealer selling to you and the dealer buying back from you? That's where the pain can hide. Now, to be fair, not every wide spread automatically means a dealer is trying to skin people alive. Sometimes it means the market is moving too fast for comfort. Sometimes it means the dealer is worried the hedge isn't clean. Sometimes it means replacement inventory is uncertain. Sometimes it means the buyer for that dealer's own downstream outlet is backing away. Sometimes it means the phones behind the table are ringing for all the wrong reasons. But yes, sometimes it also means someone is taking advantage. Both things can be true. If you don't understand that, you'll misread the room. Another dealer told me he hadn't brought much plain generic silver because he assumed the local bullion crowd would be loaded up with it. Then he got there and realized some of the people he expected to be flush with product were actually having trouble keeping the stuff around. So now you've got this weird little market in a market situation where one guy underestimates demand, another underestimates stress, and the customer just sees, why isn't there more silver here? That's how confusion starts. Not always because of conspiracy. Sometimes just because expectations were built for one environment, and the market showed up wearing different clothes. Then the conversation turned to what happened during the wild run higher. And this is where the tone changed from mildly concerned to serious. More than one person described a period where the market stopped feeling normal and started feeling like an emergency room triage desk. Too much coming in, too little time, not enough certainty, everybody trying to figure out what could be moved, priced, financed, and what risks still made sense to take. That last part gets overlooked all the time. Financing, liquidity, working capital. People online love talking about silver as if every business touching the metal is sitting on endless cash and can simply say yes to everything as long as the price looks attractive. No. A lot of operations depend on turnover, credit lines, hedge access, manpower, shipping, processing schedules, refinery capacity, and confidence that what they buy today can actually be moved tomorrow without getting run over by the tape. Once confidence on that chain starts to wobble, everybody becomes more selective, or a lot more selective. One wholesaler I talked with painted the clearest picture of all. He basically said the market went from brisk and healthy to jammed up in stages. Early on, lower levels pulled in eager buying. Metal came in and went back out almost immediately. That's a functioning market. Then prices climbed into a zone where buyers got shy. Not gone forever, just shy. The fear wasn't always that silver was bad. The fear was that the move no longer felt orderly. And once that happens, weird things follow. Product starts coming in faster than it goes out. The back room gets crowded. Decisions get shorter. Conversations get sharper. Phones get more important. Margins matter more. And every extra dollar of volatility feels like somebody kicking the legs under your folding table. That was the impression I kept hearing. Then, at much higher levels, some demand started to return, which sounds backward until you realize markets are often emotional before they are logical. When a move gets big enough, you don't just attract bargain hunters. You attract momentum people, fear buyers, latecomers, and headline chasers. So yes, demand can go quiet, then come back, then vanish again, then come back differently. And silver is one of the most emotional markets out there. It sits in this strange lane where part of the story is investment, part of the story is industry, part of the story is monetary fear, part of the story is collectors and patriotic coin buyers, and part of the story is plain old speculation. So when it moves, it doesn't move with one personality. It moves with 5 or 6 of them all yelling at once. That's why the floor conversations were so useful. You could hear the difference between someone talking about collector demand, someone talking about refinery strain, someone talking about cash flow, and someone talking about what customers were emotionally willing to do. Those are not the same conversation. One dealer made a point that I actually think is worth sitting with for a minute. He basically said, if silver is truly going to have a healthier long-term market, it can't keep behaving like a firecracker in a coffee can. It needs to rise in a way the trade can actually absorb. Because if the move gets too vertical, the very people needed to keep the market liquid start stepping aside. Everybody says they want higher prices. Fair enough. But higher prices without function can become a mess. If the route from seller to refiner to wholesaler to dealer to buyer starts clogging up, then a chart that looks wonderful can hide a market that feels terrible to participate in. That was one of the strongest takeaways from the day. The physical market can be bullish and dysfunctional at the same time. Bullish and dysfunctional at the same time. That sounds contradictory until you've talked to enough people who've had to live through it. And based on recently published numbers, some of the broader backdrop still points to a tight silver story overall. There's still talk of another deficit year globally, still pressure from physical investment, and still the issue of above-ground stocks being leaned on to fill the gap. At the same time, some industrial users are trying to use less silver or substitute where they can when price spikes get too aggressive. So even the fresh data doesn't give you a fairy tale. It gives you tension. Tightness on one side, adaptation on the other. In other words, the market is not one giant bullish straight line. It's a tug of war. If you only listen to the loudest person in the room, you'll miss that. Now, another thing I heard more than once was that the speed of the move did more damage than the level of the move. That's important because a lot of people frame this as, well, silver got too high. Not exactly. Several dealers basically told me, I can work with high. What I can't easily work with is violent. That's a different complaint. High can be managed. Violent is harder. If the metal climbs in a way that allows replacement, hedging, repricing, customer adjustment, and operational planning, the trade can usually adapt. But if it starts lurching around like a shopping cart with one busted wheel, then even strong hands start keeping their elbows tucked in. That's why some shops stopped buying in certain moments, not necessarily because they hated silver, not necessarily because they thought the whole bull move was over. Sometimes it was simply because they did not want to catch product into a moving elevator while the lights were flickering. That's a risk decision, and that's very different from saying the thesis is dead. I want to be clear about that because this is where a lot of people get sloppy. They hear that a refiner stepped back, or a dealer widened the spread, or a wholesaler got buried in intake, and they instantly jump to, see? There was never any shortage story, there was never any real demand, the whole thing was fake. That does not follow. A bottleneck is not the same thing as no demand. A refusal to buy at one moment is not the same thing as no long-term need. A stressed supply chain is not proof that silver suddenly became worthless. Sometimes it means the opposite. Sometimes it means too much metal arrived too fast for the available plumbing. That's not bearish in the clean, simple way people want it to be. It's just messy. And messy is harder to summarize in a tweet. One of the more interesting skeptical points raised during the day was this idea that if silver is supposedly so necessary, why would anyone in the chain hesitate to buy it? Fair question. But the answer isn't always because the demand story is fake. It can also be because capacity, timing, financing, and risk management still exist. Think of it like this. If a restaurant has a line wrapped around the building, that does not automatically mean the kitchen can serve infinity meals in the next 10 minutes. Heavy demand doesn't erase the stove. It doesn't create new staff. It doesn't wash the dishes by itself. Same thing here. Physical demand can be real and operational capacity can still get overwhelmed. Both can be true. From recent market updates, another wrinkle is that retail interest has been anything but quiet. Money has poured into silver-linked products in size, and that crowd behavior matters because it changes the psychology around the metal. Retail enthusiasm can amplify moves, but it can also make the trade crowded, jumpy, and more vulnerable to sharp air pockets when profit-taking shows up. So the dealer stress I heard about on the floor wasn't happening in a vacuum. It was part of a much larger atmosphere where silver had become fast and increasingly emotional. That's not a stable cocktail. Now let me shift to the show itself because this is where the story got almost funny in the best way. Even with all this turbulence in the silver market, the show floor did not feel dead, not even close. It felt alive, busy, curious, a little noisy. People weren't just wandering around killing time. They were buying, they were selling, they were asking questions, they were hunting specific coins, they were comparing prices, they were bringing in old holdings, and the dealers, even the cautious ones, were doing business. Because sometimes the online version of the market sounds way more apocalyptic than the real one. In person, things are usually more nuanced. I talked with a dealer who said trust was a huge part of why shows like this still work. People want to know who they're dealing with. They want to see the face across the table. They want to bring in coins, bars, old family pieces, maybe a stack they've had tucked away for years, and have a real conversation instead of just shipping it off and hoping for the best. That trust factor gets stronger when a show keeps coming back year after year, and this show clearly has momentum. More than one person told me attendance has grown steadily. There were people lined up before the public opening. There were giveaway promotions pulling folks through the doors. The dealers seemed happy with the traffic. And the interesting part was that it wasn't just freebie hunters wandering through and disappearing. A lot of the crowd looked like real coin people, repeat attendees, hobby people, stackers, collectors, families with kids, the kind of crowd that gives a regional show staying power. Even in a violent silver environment, the broader coin community can still thrive. In fact, in some ways, volatility brings in attention. It gets the public talking. It gets old holders off the couch. It gets collectors checking cases again. It gets people asking whether the stuff in the safe is worth more than they thought. Turbulence is uncomfortable, but it's also magnetic. That doesn't mean it's good for every business model. It just means attention follows action. One dealer told me his table was weighted much more toward numismatics than straight bullion, and he was doing very well with that. That makes sense. When bulk bullion gets too wild, some dealers naturally lean harder into collectible material, specialty silver, scarcer coins, proof sets, nicer type, better eye appeal, all the things that don't live and die quite as directly by the spot price every minute of the day. That's an adaptation. And smart dealers adapt. They don't just sit there waiting for the exact old market to come back wearing its old shoes. They shift, they rebalance, they decide where the risk-reward still makes sense. And for some of them right now, that means being more selective about plain bulk silver while still staying very active in collector material. There's a lesson in that for stackers too. Not every ounce behaves the same. Not every silver product travels through the same lane. Not every buyer values the same thing. And not every time to sell is equally good just because the chart says the metal had a big week. If you're successful, share your success story in the comments so others can stay motivated. Now, I also heard an idea that a lot of viewers will recognize immediately. If somebody has been holding silver for years, and the market suddenly gives them a dramatic price, a whole lot of metal that looked permanently tucked away can come rushing out in a very short time. That can create the illusion there was never a shortage story at all, when really years of stored-up supply hit the exit at once because the exit sign finally looked irresistible. That's a big distinction. A market can be tight and still face a temporary wave of liquidation when price gets flashy enough. Human beings are not vaults. They are people. They have bills, goals, fear, greed, regret, taxes, dreams, and spouses asking whether maybe now is the time to sell some of that stuff in the closet. When a market gets loud enough, old metal wakes up. And if enough old metal wakes up at the same time, the midstream part of the business can get flooded whether the long-term structural story remains strong or not. That was one of the most practical explanations I heard all day. It also helps explain why some dealers told me the issue was not that silver became unwanted. It was that too many people suddenly wanted to do something with it all at once. Buyers chased, sellers emerged, processors strained, dealers adjusted, wholesalers triaged. That's a chain reaction, and once it starts, it can feed on itself. Another behind-the-scenes piece that doesn't get enough attention is hedging. According to the latest publicly available market descriptions, silver futures exist in large part so businesses can manage risk rather than just gamble on direction. But here's the uncomfortable truth. A hedge is only as useful as the business model around it. If a small dealer doesn't have the scale, the tools, or the capital structure to hedge efficiently, then fast volatility hits that dealer a whole lot harder than it hits a bigger operator. That's why some of the smaller players sounded more vulnerable. Not because they're foolish, not because they don't understand silver, but because a violent market is a tax on weak balance sheets. And when that tax gets high enough, some businesses stop buying, some pull back to only the safest lanes, and some eventually disappear. I was told pretty directly that if this kind of environment drags on too long, some smaller outfits are going to struggle badly. That doesn't mean every little shop is doomed. It means survival starts favoring the people who know their lane, respect their limits, and don't confuse courage with recklessness. Especially if you're the kind of person who thinks every dealer who says no is just scared, and every dealer who says yes is automatically smarter. Sometimes the smartest guy in the room is the one who knows when not to swing. Now, let me circle back to the premium conversation because I know that's where a lot of people's minds go first. The temptation is always to reduce everything to one question. Am I getting ripped off? Sometimes yes, sometimes no. But if you want the serious answer, you have to ask a better question. Better than just, what's the premium? Ask, what's the premium? What's the buyback? How liquid is the product? How stressed is the market? And who's standing behind the quote? That's the real question. Because a low premium with a terrible exit can still be a bad deal. A higher premium with a better buyback and better liquidity can sometimes be the more rational buy. Context matters. Product matters. Dealer quality matters. And this is exactly why in-person conversations still matter. A screen can show you a price. A table can show you a market. Big difference. One of the funnier but also more revealing parts of the day was hearing how dealers describe customer behavior when silver gets dramatic. At lower levels, buyers can be enthusiastic. Then the price moves enough to make them hesitant. Then it moves enough to make them fascinated again. Then it gets volatile enough to make them nervous. Then it drops, and some want to buy the dip while others feel sick. Then it rebounds, and now everybody feels either brilliant or stupid, depending on which day they acted. That emotional seesaw is not just a side note. It is the market, at least partly. And if you are a dealer trying to keep your shop stable while your customers are cycling through greed, fear, FOMO, relief, and regret in the space of 1 week, you better have a system. If you don't, the market will design one for you, and you may not like it. Now, one more piece of fresh context that fits this conversation. This year's coin backdrop is also unusually lively because the Mint has special patriotic releases tied to the nation's quarter millennium celebration, including a special silver-proof eagle carrying that commemorative privy. So the broader coin environment already has extra collector heat in it. That doesn't solve the bullion stress story, but it does help explain why a show can feel packed and healthy, even while the raw silver trade underneath is still twitchy. The numismatic side and the bullion side are cousins, not twins. A packed show does not automatically prove the bullion market is calm, and bullion stress does not automatically mean the whole show should be dead. The organizer I spoke with seemed genuinely pleased with how the event has grown. Better attendance, strong dealer response, repeat traffic, family-friendly setup, good accessibility, the sort of things that keep a regional show turning into a real annual destination instead of just another date on a folding table circuit. And when a show finds that rhythm, it tends to build trust. Dealers book earlier, customers come back, local buzz grows, and people start treating it less like a random event and more like a fixture. That's what this felt like, a fixture in the making. And honestly, that may be one of the most underrated parts of the whole silver story right now. While the paper conversation gets louder and the macro debate gets more dramatic, the actual community level of coin culture is still being built by people hauling cases into hotels, setting up lights, covering tables, giving kids coins, and answering beginner questions. Human beings in a room. So where does all this leave us? Here's my read. The Coin Show told me silver is not in some neat, easy phase right now. It is not universally broken. It is not universally smooth. It is not a simple story where every premium is evil. Every dealer pause is bearish. Every refiner slowdown disproves the bull case, or every crowded show proves the market is perfect. It's more complicated than that. The show floor painted a picture of a market that can still attract big interest, while also punishing sloppy assumptions. A market where some dealers are operating just fine while others are stepping around potholes. A market where the long-term supportive backdrop can coexist with short-term choke points. A market where high prices are one thing, but fast prices are something else entirely. That, to me, was the message. If silver keeps climbing, the healthiest version of that climb is probably not the one that looks the coolest on social media. It's the one that gives the trade time to breathe, time to process, time to finance. Time to move material, time to let spreads normalize. Time to let normal people act like normal people instead of panicked contestants on a game show. Because if the move gets too theatrical, the market starts acting theatrical right back. And that's when stackers find out that making money on paper and actually moving metal are not always the same experience. That's the part a lot of folks still don't fully appreciate. A dealer can love silver and still say no. A wholesaler can believe in the long-term story and still slow down. A refiner can need metal and still get clogged. A customer can be right about the trend and wrong about the timing. And a coin show can be booming while the silver trade underneath still feels like it needs a chiropractor. So my takeaway from the floor was not panic. It was respect. Respect for the complexity. Respect for the people who actually have to move product instead of just post about it. Respect for the difference between price and function. And respect for how quickly a market can stop behaving the way it behaved just a few months earlier. I also came away thinking that the next layer of this story is going to be price discovery at the table level. Not theory, not online averages, real ounces, real quotes, real cash, real premiums, real buybacks. Which dealer was actually cheapest? Which product gave the best value? Which spread was fair? That's the kind of stuff that matters when you're putting actual money on the line. So I did something about it. I bought silver from multiple dealers at the show so I could compare what the market looked like in practice, not just in conversation. And when I put that together, we're going to get an even better look at what this environment really means for buyers. Because hearing opinions is good, testing prices is better. And that's where we're headed next. If you enjoyed this one, make sure you're subscribed and stay close, because the follow-up is going to be eye-opening in a different way. This one was about what the dealers said. The next one is about what their numbers actually looked like when money changed hands. And one last thing, don't let a chaotic market rush you into becoming either a blind cheerleader or a permanent cynic. Both roles are lazy. Stay curious. Ask what changed. Ask who's under pressure. Ask where the bottleneck is. Ask whether the problem is price, speed, financing, inventory, or customer behavior. Usually it's more than one. That kind of thinking will save you a lot of grief. This video is for education and perspective only. I'm sharing what I saw, what I heard, and how I'm interpreting it, but I'm not your financial advisor. I'm not your dealer. And I'm definitely not telling you what to buy or sell. Do your own homework, think clearly, and make decisions you can still live with when the market stops shouting.